Hello, this is Rebecca Pennyworth. This session for Tolley Seminars Online concerns Budget 2014 and the announcements that affect businesses. I've started off with a slide showing that tax development is really a continuum nowadays, with a cycle that revolves around both the budget and the autumn statement and of course the Finance Act. So the budget in terms of tax developments is much less important than it used to be, where tax developments were often announced and implemented within days. Now we see a much more collaborative approach between those outside government and HMRC being able to contribute to the development of both policy and detailed legislation. So many of the announcements that were made on the budget day and during the budget speech, and also are part of the budget pack, follow up on developments which might have been announced up to 2 years ago, but also include some announcements which will run far off into the future. So on business tax, let's start with corporation tax. There were no announcements about changes to measures announced previously, so we'll continue with a 21% rate of corporation tax from the 1st of April 2014, and then flowing into our single rate of 20% from the 1st of April 2015. When these rates were originally announced 12 months ago, there was interest from those advising smaller businesses about the opportunity to sideline, if you like, the associated companies rules, which are generally used for the purpose of determining the rate of tax to be paid and whether the marginal small profits rate applies. Without changes to the QIPS regime, that simplification would not have been possible. But in December 2013, HMRC announced that they had taken this point and had agreed to make a step that would enable complete simplification. So once we get to the single rate of corporation tax in 2015, the measure used to determine your payment dates under the quarterly instalments payment regime will actually use a 51% group, in other words a group relief definition, rather than invoking the associated companies rules. Quick reminder, obviously there are other contexts in which we use the term associated companies, and the existing rules, unmodified, will continue to apply in those scenarios, such as intangibles relief and so on. Moving on to R&D, this is a key plank of government policy and a very, very important part of our economic developments as an economy which depends largely on innovation and then development of those innovative ideas. So R&D absolutely central to that economic positioning on the world stage. What the Chancellor has done is rather surprising, because for many years we've believed that he is constrained from increasing the rate of payable tax credit by EU rules. The payable tax credit regime only applies to SMEs as defined for this purpose, and the definition is on your slide, but it has been pegged, and as the rate of R&D tax relief has risen, the rate of payable tax credit has correspondingly reduced to keep the payable rate at 25p per pound of spend. So we're now down at 11% payable tax credit in relation to a super profit deduction of 225% of the amount actually spent. From April 2014, and in relation to expenditure on or after that date, the payable tax credit rate will be 14.5%, bringing you to around about a third of the amount actually cash spent on R&D. Obviously, if a client doesn't have a March year end, you will have to make a split year adjustment so that you can apply the appropriate rates of payable tax credit if your client is making losses. Clearly, if your client is profitable, then the R&D is just deducted from the profit, and indeed if you do end up with R&D losses, it still might be more favourable to actually deduct those from recent profits. But if no profits are in prospect, obviously this provides an important cash flow boost for businesses carrying on research and development. Turning now to another surprising measure, the increase in the annual investment allowance. AIA was increased in a surprise announcement some time ago from the 1st of January 2013, and for 2 years the maximum amount of AIA was set at £250,000. There were some pretty dreadful transitional rules because that change came within 12 months of the previous change, reducing the AIA limit to 25,000. So here we are now at 250,000, and the announcement made on budget day indicates that the limit will become from the 1st of April for companies or the 6th of April for income tax businesses, will double up to £500,000. Now, it's unlikely to affect small businesses because £250,000 was ample investment allowance for them. But obviously, what we're doing is moving that incentive to invest in plant and machinery up the economy a little bit to medium-sized and the smaller end of the large business market. So this £500,000 limit will run through for not quite 2 years. It will end on the 31st of December 2015. With the current state of legislation, we will see the limit reduce again on the 1st of January 2016 to 25,000. But to be frank, with the number of changes in this area, who knows? The transitional rules are pretty similar to what we've got used to with AIA without the additional complexity, because in both the change to increase to £500,000 and the reduction from £500,000, we are more than 12 months from the most recent change. So that should keep it reasonably straightforward. Now a slight area of anti-avoidance legislation, but I've kept it within the business tax package here. There are some changes to tighten up the business premises renovation allowance scheme. Where a genuine business is looking to revamp property that is redundant, has been empty for a year and is in a designated development area, they're very unlikely to be affected by these changes. These changes will more likely affect the collective investment arrangements that some people have gone into to exploit these rules. So they're more along the lines of the old-fashioned EZ packages, where an investor could buy into a fund which was going to exploit this underlying tax relief. So some tightening up, changing the rules about exactly what the allowance is available on and the time frame by which building work must be completed. Still with enhanced capital allowances, and this time on enterprise zones. Now we have a system of 100% first year allowances for enterprise zones. They are very, very restrictive, and they only allow 100% allowance on new plant and machinery, on a new activity or an expansion of an existing activity, and cannot be used to fund the purchase of replacement plant and machinery. Now, in fact, the £500,000 limit on AIA does actually cover for most businesses their investment needs, but for a business starting up or expanding into an enterprise zone, this provides another 100% on pretty much everything. The time period for this 100% relief was set until 2017. It's now been extended up to 2020. And it applies only not within a full enterprise zone, but only on a designated development area within an enterprise zone. Chancellor also announced the launch of a new additional enterprise zone in Northern Ireland during the budget. Moving on to investment reliefs, and I think here from the point of view of companies seeking seed capital, the Seed EIS scheme has been very popular. It's quite a specialist area. It's only available to really tiny companies starting up, but it has been very successful, and the Chancellor has decided to make this a permanent rather than a temporary feature of venture capital tax relief. So Seed EIS now has no sunset date on it, and the CGT reinvestment, which was always intended to be a very temporary part of the regime, has also been made permanent. So in terms of investors taking tax relief on their investments, this will just flow seamlessly. In terms of the capital gains tax relief, the extension of relief applies to the tax year 2014-15. We already have a relief present in 13-14. Some developments on the creative sector reliefs included in the last Finance Act, some just minority sport areas, but the video games relief has eventually been agreed by the EU, so there's a bit of dovetailing on that legislation just to align it with the EU agreement. Small change to television relief and the launch of a new, using the same structure, theatrical productions relief for theatrical and touring theatrical productions. This is intended to be in the finance bill, but there's a bit of consultation that will happen. So it's likely to be a late add-in as the bill is passing through Parliament. It's only going to cost around 20 million a year, and I think for some of us might be quite an interesting development. Okay, well, those are the main business tax reliefs, so let's just touch on VAT. As usual, the registration limit has gone up, and this time we're hitting 81,000 from the 1st of April 2014. Do remember that that also applies to determine which businesses can use cash accounting. For the 13-14 year, it is the limit at the end of the tax year, so 81,000 for VAT and indeed for cash accounting for the last year. Fuel scale charges up, but that's separate to the budget process. So there is a table of the VAT fuel scale charges. And we've had announced, in order to comply with EU law, we need to change the rules about calculation of VAT, where a settlement discount or prompt payment discount is offered, so that VAT's charged on the full amount paid. So that will come through as a process during the finance bill, but we have got an early start for that in relation to television and telecommunications industry, where suppliers don't have to have a tax receipt supplied. And don't forget the mini one-stop shop. That is in relation to the changes in place of supply rules coming in January 2015, affecting electronic supplies and services. So particularly small software providers selling their software over the internet around the world will be affected by the mini one-stop shop. All the legislation to do that is going to be in the finance bill. Not much mention of it at the budget, but worth just remembering. Well, those are the main business changes in Budget 2014. There'll be separate sections on personal tax and also on anti-avoidance, and I hope you found this session useful. Thank you for listening.